Ladies and gentlemen, today was a rough day. Financial markets are imploding. This is the first step of that, the first little appetizer of that, unfortunately. Now, here in this video, I will discuss what is coming next for markets, in my personal opinion, all of your developments today regarding this financial meltdown, and what could be coming out here in the next couple of hours with Israel and Iran that could spruce things up a little bit. Now, I'm sure I'll be back later on tonight to give you another update if there is an update. We know most likely the Fed met today. They had a meeting, and we'll see if there's any surprise rate cuts or not. Honestly, I don't know if that's going to help or hurt this problem at this point, but the Fed needs to do something, and they're going to do something. You just got to give them a little bit of time. They work at their own pace. But again, if you have never witnessed a financial collapse, that is what we are seeing. Welcome to 2024. And if anyone tells you this is not a financial collapse, they have unfortunately no idea what they're talking about. The reason this is a financial collapse is because it's global. It's intertwined so deep in our markets. I don't really know what we could do to make it better at this point, right? The Fed cutting rates, backstopping markets, that's really the only thing that could help at this point. The Kobisi letter on X really kind of puts this into simple perspectives for everyone to understand what's going on around this yen carry trade. And here's a thread. It says, it started after the Bank of Japan, the BOJ, decided to raise rates at their most recent meeting. The Bank of Japan raised rates to positive 0.25% in their second rate hike since 2007, effectively ending negative rate policy. For years, traders took advantage of these ultra low rates. Guys, it's been since 2007 the Bank of Japan has raised rates. This has been happening for almost a decade. Okay, well, over a decade, right? 15 years or so, this carry trade has been happening. At times it's been larger, at other times it has not been as large, like when the Fed over here in the US had rates at 0%, right? There wasn't much of a carry trade because we were all at 0%. As the Fed has been raising rates, that has created a massive carry trade from Japanese investors. And it wouldn't surprise me, global investors were likely doing this as well. Now, here is kind of the explanation of the yen carry trade. It says for years, investors would borrow yen at ultra low rates, such as 0.4%, and use these yen as a form of leverage. Investors could convert these yen to US dollars or other currencies and get almost free margin. Low rates made this possible. So it was basically arbitrage on a multi-trillion-dollar level. The wide spread between the rapidly rising rates in the US and other countries and negative rates in Japan made it possible. However, as the BOJ, Bank of Japan, began raising rates, this resulted in an unwinding of the carry trade, especially as rate cuts are beginning in the US and the EU. As a result, the Japanese yen strengthened and the USD/JPY currency pair just hit its lowest level since December of 2023. You now receive 142 yen for every US dollar compared to 160 yen for every US dollar a few weeks ago. But here's why this is the key point. As the yen strengthens, many of these yen carry trades are being quote, margin called. Suddenly, the era of free yen loans is coming to an end. As these margin loans are called, the underlying assets are being sold and crashing equity markets. The carry trade is unwinding. So essentially what has happened is you have had an arbitrage trade, basically borrow in Japan, invest in the rest of the world, that has been amplified by margin on margin on margin and invested into US securities, into bonds, into credit, into all kinds of different things. And now as these individuals in Japan are getting margin called, or perhaps even in the US, if someone in the US was participating in this tactic, then you are just seeing massive amounts of selling in these securities. The problem is there's $20 trillion worth of this yen carry trade. You have seen $5 trillion of market cap value get wiped out of US markets. Basic math would say there's $15 trillion left of this carry trade. If half of that gets wiped out, another $5 trillion, that's going to mean even more selling for markets. Now, all hope is not lost. There are some things that can be done here. It really comes down to the Fed. The Fed needs to quickly lower rates and really fix this carryover trade that we're seeing here. The damage, unfortunately, could already be done. It could lie more with the BOJ, with the Bank of Japan. The Bank of Japan might have to step in and say, hey, we're not going to raise rates anymore. We see shit's hitting the fan because of what we're doing. We're not going to raise rates anymore. That would be the ultimate solution to this problem. Then again, you still have the carryover trade. But if the Bank of Japan can say, hey, we're not going to raise rates anymore, and then the Fed over here in the US cuts rates as well at the same time the Fed says in Japan they're not going to raise rates anymore, that theoretically could start to solve some of this financial meltdown that we are seeing. Do I think the Fed is going to work with the Bank of Japan and decisively take action here? I don't know. The markets are pricing in about a 60% chance of an emergency Fed cut this week. That could come out later today. It could come out tonight. It could come out tomorrow morning. It could be Friday. I'm not sure. But what I will tell you is there is massive fear out there. You've seen the VIX spike to 65 today. It's still sitting at almost 40, which is seen as really the level in which the Fed typically steps in. Anytime the VIX gets to around 40, that's normally when the Fed starts to step in and kind of backstop things. And there's a lot of historical precedents around that. So we'll see. Maybe it takes another day of selling like this, and the Fed would step in. Now, for the bull's sake, normally when you get this oversold, when you actually go under 30 on the RSI, which the RSI is exactly at 30 on the SPY, you historically see a bounce. But problem is, historically, you don't see the Japanese yen carry trade unwinding, collapsing financial markets. Like, that doesn't happen every day. It's never happened before. Right? This is a first. We've never lived through this before. This is historical, and there will be many, documents written about this specific event and this collapse that we are seeing. We've just never seen it before. So, do markets have to stop at 30 on the RSI? No, but historically, pretty much besides COVID and the COVID crash we've seen, anytime you get to 30 on the RSI, you do tend to see a bounce. Now, that's not to say we could not go lower, because let's be honest, the RSI hit 30 back on February 25th, 2020. You really didn't see the majority of the selling until really the first 2-3 weeks of March, right? That's when you ultimately hit the low. So what this really means is in the short term, again, don't be surprised if we do bounce. It can be quite aggressive as well if we do bounce. But it doesn't mean that markets are not going lower from here. Okay, markets can still go substantially lower from here. And if the Fed does not take decisive action now, markets will go lower from here, right? Based on this yen carryover trade that is, evaporating as we speak. It's kind of like dominoes. If you got a whole thing of dominoes, hundreds of them stacked up together, and you tip that thing over, well, they're just all gonna go, right? And it's just gonna keep going. It's kind of like what you're seeing right now with the margin. When people are getting margin called, that's sending these stocks lower. More people are getting margin called. More carryover trade is getting margin called. And it's really just a snowball effect that could get, quite frankly, out of control. Now, if you backstop that, if you take a couple dominoes out of that theoretical analogy, then half of it's going to fall and half of it's going to stay, right? Roughly speaking. So that's kind of what we're looking forward to next. Is there action taken to stop this, or does the entire financial sector crumble? Is this the catalyst that pushes us into a recession? And I think that's why you really didn't see much of that buy the dip mentality actually come out today. At one point you did. At one point it looked like markets might even want to go green on the day. And then it all gave way throughout the rest of the day. Into the close of the day, things just got worse and worse. You can see the Russell 2000 is down 3.69% today. The NASDAQ is down 3.81%. The S&P is down 3.18%. And the Dow is down about 2.69%. And at the time of recording this video, we don't have any new information from the Fed specifically. Austin Goolsbee this morning said that the Fed would step in if they need to. He basically said everything's on the table right now. We didn't get much new information, but there has been a lot of rumors that there is a Fed meeting today, that the Fed did have a meeting and could potentially be coming out with an emergency cut. So if that does happen tonight, I will bring you that information as soon as it does get released to us. Also, you have this Israel-Iran situation. Iran is expected to attack Israel in some capacity coming overnight tonight. At least it hasn't happened so far. It is night over in Israel right now, or heading into nighttime. So anytime now that can happen. And again, that's one of those things that really hits the headlines, that looks scary on the headlines, but I don't think that actually matters too much in regards to our markets. We know it's coming. It's very well televised, right? It's not going to catch the markets by surprise. Now, if there's a lot of damage done or something along those lines that could lead to a larger conflict, Hezbollah gets involved, obviously that's something we will reassess when that does happen. But judging off the information we know, I think it could actually be a buy the news event for markets. If the situation comes and goes and that's it, it's going to be a buy the news situation. And that could actually help markets a little bit, believe it or not. But this Japan yen carryover trade needs decisive action from either the Bank of Japan or the Fed, preferably both at the same time, to really stop this situation and to backstop markets. Again, and there's been a lot of people that have said, hey, why would this happen? Like, why would the Bank of Japan or the Fed step in and stop this? And it's because of financial stability. When you see markets start to collapse like this, you really threaten financial stability, right? You threaten the underpinnings of the economy, which the stock market is the underpinning of the economy. If the stock market gives way, you have massive problems, okay? You will go into a recession. And you're getting to the point where it's better to act sooner rather than later. If the Fed waits too long and there's too much damage done, the markets may not react as well to the Fed actually stepping in and trying to do something. And at that point, there could be too much damage already done. And then to make matters even worse, we don't know who's getting blown up from this. There could be U.S. banks getting blown up from this. There could be, a lot of Japan banks are getting blown up from this, but we just don't know the direct implications, right? So it's like if you're getting sick, you'd rather just take some medicine now, take your vitamin C before you're feeling like absolute dog crap, because maybe that will help more than taking it when you feel like absolute dog crap, right? It obviously would. It's kind of like that same situation. You want to step in before it's too late. Again, historically, markets tend to fall a lot when the Fed cuts rates, but I don't think what you're seeing right now is really a growth scare. Now, I'm going to play a clip from Tom Lee here in just a moment. He says we'll look back at this and say it was all a growth scare, but unfortunately, Tom Lee is wrong on this. A lot of Wall Street is wrong on this. Yes, last week was the growth scare. That was the growth scare sell-off, and that means part of this drop you can say was a growth scare. But right now, it's not a growth scare that is causing markets to fall. It is this carryover trade. So from that perspective, I think if the Fed did step in here, it would, at least in the short term, help markets. Because logically, the Fed's not cutting rates because of growth problems. They're cutting rates because of financial problems, because of Bank of Japan problems. That's not necessarily correlated to the economy at this point. Stock market crashing, if it does crash further, could have financial implications. It already likely does have financial implications for the economy. But right now, I don't think it's fair to say the Fed cutting rates would be worse than them not cutting rates. I think the Fed cutting rates, doing something decisive now, would be seen as favorable by the markets. But if they let this thing go too far, it becomes less and less effective.
Tom Lee, managing partner, head of research at Fundstrat Global Advisors, as well as a CNBC contributor. In times like this in the past, it always would help to know, Tom, whether it's a sharp, scary spike down, which a lot of times the other side looks just like it, or people are hoping for that so much that they don't see that it might have longer to go. Do you get the feeling that this is not going to be a major sell-off?
For now, I think it is the former that you described. You know, we have over 3 days, suddenly markets reversed and, you know, Japan down over 20%. And as you're pointing out, the NASDAQ could even, you know, decline further. Declines like that are generally symmetric, but you have to watch the VIX. And when the VIX peaks and starts to roll over and fall down, the recovery can be just as quick. I think a lot of this depends on whether financial conditions in the U.S. start to tighten, you know, meaning like, do markets seize up? But with interest rates falling, you know, the consumer's still in pretty good shape. I think on the other side of this, it'll look like a growth scare. But it doesn't mean that
it's a
today's
growth
the bottom.
Scare.
Yes.
It's kind of interesting that it almost looks like the market's doing what the Fed didn't do again. It's almost like once again they're there, but not really ahead of what's happening, and they're reacting, not anticipating, kind of again.
Yes.
On the way up and on the way down.
Yeah, the 2 years is signaling that the Fed is behind because 2-year yields have fallen further. But it does seem like, as we look back, a lot more this is because of the surprise hike from Japan and the sort of knock-on effects from there. If that is the primary source of the reaction, I know it's going to be tumultuous for markets, but for the U.S. economy, it's not necessarily bad news, and I think that's why we can balance.
Some of your great and accurate calls have been based on inflation coming in like you thought, much cooler than the market was thinking at the time. I guess the flip side of that is that there can be the dual mandate, there can be labor market weakness associated with why that's happening. Was the asymmetric risk, maybe it wasn't asymmetric, maybe there was a great risk to the job market?
Well, you know, markets don't like surprise. I mean, Friday's jobs report was disappointing.
How far back did they go with revisions down, too? It almost looked like the whole story, the whole narrative that we had is suspect about
That's right. And I think many expected that because, you know, the establishment survey versus household had so many gaps. And so that's kind of converging. But that means markets are waiting until August payrolls report, which is not for 4 more weeks, to really know. But I would say, to me, it still seems like July, even as bad a report it was, is more of an aberration. And I think the trend is still...
Weather, there's a couple of things in it that people...
Yeah, there was almost a record number of people that were having temporary layoffs and people who weren't working due to bad weather. And Texas had a big spike in jobless claims. So it does look like the hurricane had some effect, although the BLS said there was no effect.
On Thursday night, one of the people at your shop said 53.90 looks like a good S&P support. Do support levels mean anything? And you want to give me another one, or is it just another one to go through?
Well, you know, because it didn't hold, it means that there are other support levels that could be important.
It might not hold.
Yeah, it could not. I think that the VIX is telling us that.
We've got to watch the VIX.
Yeah, because it spiked Friday, and then it's spiking again today. I mean, the last time the VIX was at this level was April 2020. So for an investor, that tells us kind of where we are, which is we know markets are nervous and they have to unwind, but it's not been a bad time to be thinking that there is a big opportunity on the other side, because once the VIX starts to calm down and markets have already corrected, we know that there's opportunity.
Right. I mean,
knowing that, of course, it's August, as you point out.
You think the VIX high 40s is where it's going to peak, or low 50s? I guess, it's up 100% almost.
Yeah. The VIX may not have a ceiling, because we know next couple of days there's also some geopolitical events on the horizon.
And Israel, and Iran, and we got politics here.
I mean, that's escalating. Some people think, well, that's going to turn into a nightmare this week.
Supposedly today,
or
right. Tomorrow. I mean, we don't want to.
So I think that's why it's all coming to a head this week. I mean, to me, it's a very important week, because we know it's hard to catch a falling knife, as you're pointing out. Support levels are being broken. But mortgage rates are falling. The consumer's in pretty good shape, and the job market. I think it's very unlikely.
But so if the knife is falling, and you like catching falling knives, I know you. So the question is, at what point do you catch said knife?
I spent a lot of time talking to Mark Newton, our technical strategist, over the weekend, and I think that there is a reprieve coming this week. Like, who knows? It could even be today, right? We could open down huge, and then after 11 a.m. we could reverse higher. But I kind of agree with Joe that this is still August, and I think that markets traction really doesn't come back till October. So between now and October, it's maybe a range-bound market at best, but there'll still be opportunities.
And we could call it Bitvidia, basically. I mean, it might as well be Bitcoin. What is Bitcoin? Gold's hitting new highs. Bitcoin, yields. People look for safety. They buy treasuries, they buy gold. People don't buy Bitcoin for safety.
Yeah, Bitcoin is still mostly a risk-on asset. And, there's potentially been lots of liquidations. I think several 100,000 accounts liquidated over the weekend.
So as you heard there, Tom Lee expects that this will be seen as a growth scare when we look back. He thinks markets could just trade sideways for the next couple of months. And I'm really under that assumption as well. I think political uncertainty, geopolitical uncertainty, Japanese yen trade, unwinding. I think best case scenario is a sideways market, right? And I expect we're going to see a lot of volatility, lots of big up days, lots of big down days. So from, I guess, that perspective, I agree with Tom Lee. But I don't think this drop in markets, really the last 2 days, has anything to do with growth, right? Or growth scares. It just doesn't. It has to do with margin calls, and it has to do with Japan. Although the data is hard to find in this, trust me, I was trying to look for it. Japan is the single largest owner of U.S. treasuries. Part of that is the carryover trade, borrowing money in Japan, buying treasuries in the U.S. that pay 5%. Why would you not do that? But from that perspective, just think about how much of our markets could actually be owned by Japanese investors as well. And I guess when you start to think about that, the trade unwinding could go a lot further. And the lower we go, the more margin calls we get, the more selling, the more liquidation we get, the lower prices, the more margin calls. It really is like the domino analogy. When things start to really tip over, it could take everyone else out with it. Now, I think with Tesla stock specifically, you were down like 14% in overnight trading last night, down to the low 180s. Now you're back around the 200s. I think you've seen a lot of resilience from Tesla today. I think things could have been a lot worse for Tesla. Tesla was down less than Apple today. I think that just shows you the strength here with Tesla, but Tesla is not immune to what happens in the broader market. So yes, I think things look good from that perspective. Tesla held up well. There's catalyst upcoming like the robotaxi event, but whatever happens in the markets is going to have a large effect on everything, Tesla included. So I think you want to look at this and say, what's doing better than other things, right? In terms of your shopping list, you should have a shopping list ready to go if this gets even worse. Personally, I'm not buying anything right now because I think it could get worse. And I think when the economy gets worse, it will get worse. Okay. Really over the next 3 to 6 months. That's the main kind of catalyst that I'm looking forward to. This Japanese, carryover trade imploding. That's just, the start, right? At least from my perspective. But I do think that means Tesla stock can go lower. You need to be prepared for Tesla stock to go lower. And if you would freak out if Tesla was $150 or $140 and get margin called or something crazy, then I think you need to really evaluate your position now. I haven't sold anything. I haven't sold a single stock throughout all of this. I just plan to buy more. And that's my plan going ahead. But again, I just want to be very clear. Tesla is not immune to this. It looked great today. Tesla bounced a lot more than a lot of other stocks, but it can get worse from here. And that's the bottom line. So we will see. I'm sure there will be another video posted here to the channel later on tonight with any new developments, because I think there's going to be some new developments tonight, whether Iran is real or whether it is the Fed. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.